May I now ask the Governor of the Central Bank of Nigeria to share his perspective. Thank you.
Thank you very much. The Right Honorable Patel, the Secretary of State for International Development, the CEO of London Stock Exchange and Management, distinguished ladies and gentlemen, good morning. It is my deep honor and privilege to be with you this morning to address a gathering of what is undoubtedly some of the best and brightest people in global financial markets. And I'd like to especially thank the CEO of the London Stock Exchange, Nikhil Rathi, and co-head of the emerging markets, Ibukun Adebayo, for making my attendance today possible. In my remarks this morning, which I have titled Issues and Challenges Towards Engendering a More Vibrant Capital Market in Nigeria, I'd like to briefly share my thoughts of the present economic situation of our country, including the Nigerian capital market, highlight the actions that we have, that I believe we have set us on the path of recovery, present an overview of the Nigerian capital market over the last couple of years, and proffer some ideas, the Nigerian Stock Exchange, with a view to creating a more vibrant capital market in Nigeria. I hope I can do all this in the allotted time. As you all know, Nigeria, like the rest of the world, has been dealing with several major exogenous shocks, namely the significant decline in commodity prices, the U.S. monetary policy normalization, geopolitical tensions, and global growth slowdown. In the aftermath of this, we recorded the following: gross domestic product contraction reaching minus 2.3% during the third quarter of 2016, having grown by nearly 7% in previous years. Rising inflation peaking at over 18% in January 2017 from as low as 9% in January 2016. Significant depreciation of the exchange rate peaking at about 525 naira to the dollar in February 2017 from as low as 155 naira to the dollar in June 2014. Depletion in the foreign exchange reserves bottoming at about $23.6 billion in October 2016 from as high as $40 in January 2014. Strain on the banking sector, with industry-wide NPLs rising from 3.1% on the average in January 2014 to 12.8% in May 2017. Constrained fiscal space leading to larger fiscal deficits and rising debt profile, though our debt to GDP ratio remains significantly robust and below the 30% threshold, and loss of investor confidence in the stock market, which lost over 1 trillion naira in 2016 alone. In view of these developments, the Central Bank of Nigeria took several major policy measures. To mention a few, we instituted a tight monetary policy stance in order to rein in inflationary pressures, with monetary policy rate hiked in July 2016 from 12% to 14% and maintained there since that time. We have also used open market operations to support the tightening measures. We changed the structure of our trade balance. In effect, we established a decisive withdrawal of the de facto subsidy for the importation of goods that can be produced in Nigeria. We pursued stability in the exchange rate market. The central bank took a number of actions to punish speculators, bettors, round trippers, and rent seekers. We encouraged increased FX inflows from remittances by licensing international money transfer organizations, IMTOs. We also increased FX supply into the interbank market and established the investors exporters window in April 2017. We increased development finance activities and accelerated it very greatly, aimed at diversifying the Nigerian economy away from overdependence on oil revenues. We had targeted interventions at specific high-impact sectors like agriculture, including introducing the Anchor Bora program, which is a program that is meant to stimulate agriculture and further grow wealth and transfer wealth to our rural community in Nigeria. In light of this and other policy responses, we are delighted that the economy has turned the corner with our worst days clearly behind us. And I say worst days clearly behind us. For example, GDP after 5 quarters of consecutive contraction, beginning from the first quarter of 2016, the economy recorded 0.5% GDP growth in the second quarter of 2017, signaling an exit from the recession. Indeed, a couple of months ago, when I was at some sessions, I was at the Senate, from there to University of Nigeria and Nsukka, I said it, that Nigeria was going to exit recession during the second quarter. So many pundits said what they doubted it, but at least today we are here to say yes, during the second quarter we did exit recession. And I'd like to say here that the direction can only be positive and it will be aggressive going forward. We know it's a fragile growth. We realize that yes, like I said earlier, our growth trajectory has always been at about 6 to 7%. With population growing at an annual rate of 3%, we do know that we have a lot of challenge. So at 0.5%, it is a non-issue. But I'm saying that we are all determined to see to it that growth goes back to the level that it was before, and I'm very positive that we will get there. Inflation, we have recorded 7 straight months of moderation in inflation, from 18.7% in January to 15.9% in September 2017. On exchange rate, we have also seen a significant appreciation of the naira from over 500 naira to the dollar to about 360 naira to the dollar today. In addition, we have seen stability in the rate for over 3 months now. On FX supply, since the establishment of the investors and exporters window, we have recorded over $8 billion in autonomous inflows through this window alone. FX reserves. Our reserves have recovered significantly from a low of just over $23 billion in October 2016 to over $34 billion as at the 24th of October 2017, just approximately a year. Capital market metrics. All share index and market capitalization recorded 32.10 and 32.3% respectively to 35,504 and 12.24 trillion as at August 31, 2017 from the end of December 2016 levels. On foreign investment, despite the disturbing trend of capital flight from emerging markets, in the second quarter of this year, we have recorded 50% growth in foreign direct investment and 130% growth in foreign portfolio investment. In a major move towards better integrating Nigeria's capital market with the rest of the world, we've heard about some of those offers that have come into the market. A few of them, the Zenith Bank, the IHS, and the UBA, 3 Nigerian issuers, have accessed Eurobond markets over each of the last 2 years. And by the second quarter of this year, $1 billion of corporate Eurobonds had already been issued. Despite these signs of improvement, there is still a lot that needs to be done. For example, there has not been an IPO, and I'm happy that today we've heard that there will be an IPO sometime this year and sometime soon. These challenges are not unique to Nigeria. Sub-Saharan Africa continues to struggle to penetrate international capital markets. Indeed, the value of international sovereign bonds issuances in the region fell to less than $1 billion in 2017, while it rose to almost $140 billion in other emerging markets. Nigeria is still far from the efficient financial and economic system befitting a country of its potential, and vibrant capital markets are a crucial part of the blueprint. In order to achieve the scale of coordination and activity necessary to put our capital markets onto the next levels, I'd like to suggest two principles for the Nigerian Stock Exchange. One, seeking out partners, and two, stretching our mandate. Partnership is very critical in everything we do in life. And indeed, partnership is the reason we are all gathered here today. A belief in the idea that when people or institutions unite towards a common cause, they can create something greater than the sum of their individual parts. Through its partnership with the London Stock Exchange, various Nigerian stakeholders have accomplished previously unimaginable feats, including a federal government-issued diaspora bond. It was the first time any sovereign African nation had registered with both US and the UK authorities and targeted sales at retail investors. The bond was oversubscribed by 130% and raised $300 million. I believe that the Nigerian Stock Exchange must continually seek ways to partner with iconic and well-established exchanges like the London Stock Exchange. Indeed, a lot of what we may be seeking to do and achieve have already been tried and tested elsewhere. So this is the time to stand on willing shoulders and move on to the next levels. In terms of stretching your mandate, I believe that institutions must understand their social, economic, and geopolitical boundaries in which they operate, and within the limits of their mandate, be innovative enough to try new things. For example, as a monetary institution in a developing country like Nigeria, the CBN always believed that it cannot stand idly by and concentrate on inflation, interest rate, and exchange rate, while people perish in poverty and unemployment. That is the reason we have always engaged in development finance activities outside the textbook approach to central banking. Obviously and measurably, we have had great success in these endeavors, and it is in this light that I suggest the same approach for the Nigerian Stock Exchange. Imagine if a startup like Uber had first launched in Nigeria. Would it have found funding from the Nigerian Stock Exchange? Does the Nigerian Stock Exchange have space and products to cater for such venture firms? Here we're talking about SMEs, and practically as a virtually unknown institution. Because it is a technology app, stakeholders may have assumed that it should not qualify for certain financing schemes. Yet, today, Uber and its many competitors, including Nigeria's homegrown Oga Taxi and Easy Taxi, have created thousands of working class jobs, boosted family incomes, and lifted people out of poverty. But in Nigeria, we may still be too focused on conglomerates and blue chips companies, whereas the productive power of the startup ecosystem may be ignored. In this light, therefore, I urge capital market stakeholders across the continent to determine what policies and partnerships are necessary to broaden their investor bases as well as boost issuer participation to stimulate both the supply and demand for capital. Capital markets play a crucial role in sustainable and robust growth of any economy, and Nigeria is no exception. These are indeed times for decisive actions, and we must be decisive in Nigeria. I believe that the scale of activity and coordination required to deepen Nigeria's capital markets is significant. But we are up to the task. Let us create more nodes in our network, lift our entire organizations outside the box, and see Nigeria achieve the vibrant, productive capital market that will become the envy of many. I thank you all for your attention. Good morning once again.